Thank you very much for joining us this Friday. Hello and welcome to this week's episode of CRB 101. It's a bit different today because we are coming live to you from the Oval in Westlands. Thank you very much once again for joining us. I am Alan and we are looking forward to having in-depth conversation with you. You know, whenever you join, there's always a thing or two to learn. Na kama kawaida, I'm never alone. And today, this is such a special episode, especially to me and to CRB 101 because I am joined by the General Manager, Tala. Tala is one of the biggest DCPs, digital credit providers in the country right now. Very good to have you on the show.
Thank you for having me.
Really good to see you. Mm-hmm. It's been a minute.
I know it's been a second, but this is the best topic I could think of, so let's go for it.
Thank you very much. We know you're a busy person, so we just want to appreciate you for spending some time out of your busy schedule so we can have this conversation. Mumbi is a friend of ours, of course, and she's very informed on this topic. So we are looking forward to really learning from you today.
Sure.
So straight into it. We know that traditional lending has been the thing for a very long time, but digital lending is coming into the space and coming with the bang. Now, what are some of the differences you'd give between traditional lending and the digital lending space right now?
Yeah, so I love to give stories. So
Yes, and we love stories.
If you think about it, I like to do the parallel of how financial inclusion has grown.
Yes.
So let's start with the first, what I call like the first phase of the first decade. One of the first pioneers in digital credit actually came in 2014. So that was when the likes of Tala were actually coming up.
Yes.
And if you think about that period, essentially if you didn't have a bank account, you could not access formal credit.
Totally.
And I always use the word formal credit because people are still borrowing.
Yes.
Borrowing from shopkeepers, family and friends.
Yes.
But why couldn't you access formal credit? It was just a factor of one, was your data digitalized or digitized in this instance? Number two, did you have formal income? And I do think those are literally the biggest challenges that banks had in terms of opening up access to credit. So what changed in that period is the advent of using alternative sources of data to underwrite. So when you think about alternative sources of data to underwrite, it means how can we actually leverage your transactional history across different platforms with customer consent? How do we leverage different signals to do with when we leverage things like machine learning, AI, etc. to underwrite? And that first phase opened up a lot of access. I was looking at some numbers for a presentation I had last week, and essentially financial inclusion numbers across Africa have doubled over the last decade. So that was for me is how I think of the big difference between like traditional lending and what I'd call like digital credit that's available. The biggest power is actually data. How do you get a scope to be able to underwrite an individual using alternative forms of data and moving away from the more traditional path of bring an envelope full of documents to a branch somewhere and really democratize access. And last thing I'll say before we move on is, so then if I think about the next 10 years, it just becomes more about what I call personalization. So moving from a place of one size fits all in terms of the credit, but now leveraging data and even newer technologies that are coming up, leveraging LLMs, AI, to just really think about how do I make sure your credit fits exactly what you need as an individual. And that's going to be powerful.
Great points. And I love it that you're giving distinct differences, because I know like traditional lending, if I walked in a bank right now in a suit, they'll probably give me some good money, as opposed to, if I went in shorts and stuff like that. And you've also touched about financial inclusion. And I just want to bring this question. The research is showing that 9.9% of Kenyan adults remain financially excluded. I know digital lending has really come and is bridging this gap, but most of these people, the 9.9%, are the youth in the rural areas. And this is majorly because most of them do not have mobile phones, and if they do, they are those katululus, right? others do not even have IDs. Now, how do you see digital credit contributing to the financial inclusion, particularly for underserved populations?
I love that. And to be honest, this is a conversation we've been having a lot internally, Tala, and also with partners within the industry. If you think about, you can't talk about financial inclusion without talking about, one, there's phone penetration. Actually, three things: phone penetration, then moves into smartphone penetration, then moves to internet penetration. And I do think that while the initial access was sold for in urban areas, a lot of rural areas are left out. And that's because, back to what I was talking about earlier, with credit, it's all about data. Their data is still not digitized, it's still a cash economy. So then how do you bring these people into the fold? In my mind, it's two things. One, how do you find, how do we define products that can essentially improve those numbers that we're talking about around phone penetration, even if it's feature phone penetration, in all honesty, moving into smartphone penetration and internet penetration. So this means taking these really expensive products and breaking them down into costs that are affordable for people. And we've seen some amazing use cases, just to call out the likes of M-Copa, who's really focused on making sure people actually have the devices they need to be able to essentially generate income. We've seen on the internet side, there've been players like Point and who are coming in and really bringing the cost of access to internet down. So Ficom and Airtel have done a really good job at breaking down the cost of bundles to 10 shillings, 5 shillings. I think that's a first step. I think the second step is a big role that fintechs can actually play. I always say that gone are the days where you can build a digital-only business. It essentially has to be a hybrid model. What I mean by a hybrid model is you need to find a way to exist where your customers are. And this means moving out of the areas we're in and social media to creating agent systems where people who are still primarily leveraging cash can still be brought into the ecosystem. So I do think it has to be both sides of the industry almost like playing their role, but it is one of the bigger things that we need to solve for. And
I love it that you are shouting out those who are really doing some amazing work, just to make sure that everyone is able to access at least a smartphone, internet, uko mashinani, and even power. I hope our government will make sure that we have electricity uko mashinani. Now, then who is the primary target for the DCPs? Who's the target audience for the DCPs, and how do their needs, expectations differ from those traditional lenders?
I always try not to speak too much to all DCPs, because I do think DCPs are very varied. So I'll talk specifically I'll talk about Tala, because I know I understand the Tala story. So what a lot of people actually don't know is Tala is a very mission-driven company. So our founder is actually ex-UN, and our goal is actually targeting what we call the global majority. So these are people who've been left out of formal financial ecosystems. So in all those words, this just means if you're not the target for a bank, that's who we want to serve. We want people who would otherwise not have access to these financial services. At the end of the day, what does this translate to? We've seen we call them 3 or 4 categories of customers who use Tala a lot. One is people who are salaried and they essentially have an income gap. It's week 3 before your salary comes, week 3 of the month. You need to buy gas. You're actually able to use Tala to cruise to bridge that gap. But you have a health emergency and you need some support. The other big percentage, which has actually been up to 70% of our credit today, is actually for MSMEs. So we see a lot of people who are actually borrowing to maintain cash flow within their businesses or to actually grow their businesses. So that's also been another big use case that has been great to see. And I would say the third one is actually a hybrid of the first two, which we call them the side hustler. where you find someone who has a full-time job, but they essentially also have a side hustle.
Yes.
So you might find sometimes they're borrowing for rent or fees, sometimes they're borrowing to keep their business going. But these are the biggest use cases that we've seen. As to your question on how that compares versus banks, I would say banks tend to focus on more formalized sources of income. So someone who has a very stable income, or a business that has been operating for years and is a lot more stable. But for us, we think of it as, hey, who's serving the majority of the world? We call them the global majority in emerging markets, and that's where we actually focus.
And I must commend you for actually just making sure that the funds are available for everyone. Gasa is Isha and Tala is here. Good job you're doing. Earlier you talked about technology and AI is a big thing. Now, how do technology advancements like AI, like you were saying, impact the digital credit space?
I would say that's a big one, and I'm always very careful not to use big, like just say AI, machine learning, blockchain, because they can be buzzwords.
Yes.
And I was talking about this in the Africa Tech Summit last week. But the most important thing for you to think about as a fintech is how do you take the big technology and put it in very practical use cases that move the needle in financial inclusion. That's the measure I think about. So let's take an example of machine learning, which is where we started, where we were able to actually take big amounts of data, turn it into signals and features that inform our underwriting, our credit score, and offer credit. So the value with AI is you're actually able to now digitize the data. So what does this mean? In the past, if, for example, someone sent a payslip, someone has to manually look through it. Right now, you can be able to feed that into AI, which acts as a parser, and do that a lot faster to gain insights on, this is a customer I should give a loan based on ability or not. It could even move to some interesting concepts we're thinking about, which is take a picture of someone's inventory for their business and be able to actually predict the value of that business and give someone a loan based on the value of the business they have built, which is very powerful. So I do think those will be some of the interesting use cases we'll start to see, because at the end of the day, it's more how do you reach, especially industries that haven't been reached. We talk about 7 million MSMEs in Kenya. I've had numbers as high as $19 billion in funding deficit for MSMEs. At the end of the day, if you talk to any bank, the challenge is actually we just don't know how to underwrite them. The money is moving in cash. They don't have bank accounts. They're probably not registered. And I think this is where technology can come in to solve those problems.
You talked about how easily available you make these funds to the global market. What are some of the factors do you think would make a customer choose digital lending over traditional lending like banks?
And actually, just to pull a report actually that I find very valuable. So each year we do we release our Money Match report. We've done it for the last 4 years, and this is driven largely by consumers, where we ask them, how are you using credit? How valuable is it? How financially healthy do you feel? What are the considerations you have? So this is just an example from 2024. It was about 80% of customers saying it was interest rates that they look at. It was 73% saying repayment period. So they really care about how fast they actually have to pay my loan back. The third one was actually loan processing time, which for me, I think of it as accessibility. Most of the time, if someone is coming for credit, they have an emergency, have an urgent need. So will this take me a week, or will I get it instantly? The other one is customer service, which we know is really big in Kenya. Even as you're taking credit, money is emotional. How safe do I feel with the lender or the partner that I choose? And last one, which has found to be very interesting and has only been there for the last 2 years, is a lender licensed by central bank. That was about 40% of customers. And this does not surprise me, because we know we've had a lot of issues around consumer safety. So customers want to make sure that whoever they're dealing with is legitimate and that they're safe in the process. Yeah.
So when you say a good percentage talked about the interest rates, do you mean that the interest rates that the digital providers give is lower than the banks?
I think it depends on how you look at it, because banks have two types of products today, which is another big transition we don't talk a lot about. So there's the longer term credit where it's tied to like a CBK based lending rate. Someone is taking a big loan for business, etc. But right now, if you look at the trend, is every bank actually has a digital loan product.
They do.
So even when we talk about how we compare, like for example, if I was to compare any bank's digital lending product versus how much Tala charges, I would say it's pretty much at par. If anything, if I compare with Tala, of course, to speak nicely about my company, is we actually prioritize flexibility. So we're one of the few, if not the only lender in this market charging you interest per day. So that means that if you take a loan for 15 days and you get money at day 5, we'll only charge you for 5 days. You don't need to pay interest for 15 days. But what you find with a lot of like banking products on the digital lending side, you still have to pay the full interest. So for us, our goal is making sure it's on reducing balance, putting money back into the customer's pocket. So that's where you find the interest rates start to, it's fairly the same thing.
Okay, great. We are still live. This is CRB 101. If you're watching, we are live on Facebook, Metropol CRB. We're also live on X, Metropol CRB. We'll make sure to upload this episode on our YouTube channel, Metropol TV Kenya. If you have any questions whatsoever, you know what to do. You can type your questions on the chat box and we will be sure to answer them. Now, Mumbi, COVID-19 impacted the country massively. Would you say that before COVID, consumption was different from now?
Ooh, that's a good question. There's a term we've been using internally called the perfect storm.
Right.
And I would say COVID was the start of the perfect storm. So that's why I wouldn't say it's an apples to apples comparison of post and pre-COVID. Because if you look at the last 2 years, we had some of the highest inflation rates in Kenya. I like to spend a lot of time with customers on the ground. Like the last 2 weeks have been just on the ground in my rubber shoes talking to customers. And any Kenyan you talk to today will tell you that they're having a very tough time. So I would say it's not an apples to apples comparison because our economy is still struggling and people are still recovering. The flow of money is not as it has been in the past. But I would say that of course COVID did not help with the situation. Even just giving an example for Tala, we actually had to pause lending for about 6 months.
I remember
during that period. But it was because it was highly undefined and no one knew what would happen. Customers had lost their sources of income. So I do think what Kenyans are experiencing right now, in my mind, and how I think about it, is the perfect storm. And we can even add climate shocks in there. We were all part of floods last year. We've seen drought affecting quite a number of people in Kenya. So I do think there has been a lot of challenges even post-COVID at a macroeconomic level that has affected people's livelihoods.
Let's talk about a survey that was done by the Fin Access household last year, and it stated that the usage of Hustler Fund, let's talk about Hustler Fund a bit, services was at 28.9% of the population. Now of this represents like around 8.1 million of the adult population, where 35.4% are urban dwellers and 24% of that are rural dwellers. How has the uptake of Hustler Fund impacted digital credit provider space?
Well, I would need to check like metrics for like full industry, but I can speak to Tala. So far, there has not been impact, and this is why. If you look at Tala, we've been in Kenya for about 10 years. Our average customer is getting a loan of 15,000. If you look at limits that are offered within Hustler Fund, there's still a lot of growth to happen, and I know the government is working on that. We are actually happy to support anytime, but I do think that it solves for a big need that even Tala wasn't solving for. But I would say there's still such a huge space and huge market that we're not. We're not fighting for a slice of the pie. I think the pie is so massive in Kenya that actually for us we think of ourselves as an ecosystem enabler. We are happy to work and support with anyone who's looking to introduce credit to the market because, as you mentioned, the numbers look good, but it's still a lot of people who are not rich. There's still a lot of need. There are a lot of people who need support at different stages in their lives. So I would say for me, I feel like it's more complementary to what we do rather than it coming in as direct competition. Yeah.
Still on the report, loan default rate increased from 10.7% in 2021 to about 16.6% last year, 2024. Now, as Tala, let's talk about Tala. How are you dealing with the default rate?
So I don't know, is that specifically on banks, on the bank side, or is that for...
Generally.
Generally.
Yes.
Yeah, I would say if you look at actually what was happening last year with the banks, it was actually to do with increase in interest rates, with the CBK-based lending rate going up. So that was actually, it didn't affect us because at the end of the day, our cost of credit has remained the same and fairly stable. So luckily, we've had a very stable business, in all honesty. Our defaults or NPLs are still under 5% for our active customer base. But that said, I'm always saying that we're very cautiously optimistic because we understand Kenyans are going through a really tough time. And especially for people who have more volatile income, especially micro and small businesses. So we choose to stay very close to our customers and actually prioritize flexibility in how we structure our products, like making sure that if a customer actually has a rough or a tough time, they know that they can reach us and we'll be able to support.
We've talked about banks quite a bit, and at the moment we are moving to an era or a model known as risk-based pricing. All right. Now this just ensures that each customer is unique. They get tailored loans, different interest rates. Do you think this model is going to affect the digital credit providers? Do you think that the consumers of your products will start moving back to the banks because of the solutions?
Yeah, it's a good question. I would say that, number one, as Tala, we have been proponents of risk-based pricing. I think probably we have used it for a longer period than anyone else in the market. I think it's been 9-10 years so far. What I love about risk-based pricing, just for context to everyone, is you're bringing the value back to the customer. So essentially with better repayment behavior, you're actually able to access much lower interest rates. So what I love about banks actually going into it, I think it will really streamline value and especially give a lot of benefit to good borrowers. At the end of the day, I don't think that customers migrate purely based on interest rate value. I think there's a lot of the emotional benefits, like what is the relationship that exists between you and the lender. But generally, I would say that for any DCP that doesn't evolve fast enough, I think then there might be tougher periods coming up. Where at the end of the day, it needs to be less about driving maximum profit and more about how do you bring value to the customer? How are you allowing them flexibility and choice? How are you allowing them to have affordable access to credit, which is one of, if you remember earlier I was talking about personalization. I'm a big believer that the next 10 years are actually less about access, but more about personalization. And this is one of the examples. And for us as Tala, how we stay true to our customers is by really sticking to that core. How do we personalize your experience for what you need? Let's say everyone gets a 30-day tenure. It's more you choose the tenure that works for you. And just the same translating to pricing as well.
And when we talk about risk-based pricing, a customer's credit score is such a big factor. right? And credit reference bureaus, CRBs, are playing such a significant role in the credit ecosystem right now. Now, how do you see CRBs influence the ability of borrowers to get financing from the digital lenders?
Yeah, I would say, and this has been a big, subject and discussion for us at Tala, is we need to start with education, consumer education. I do think a lot of customers don't understand what a credit score even means. They don't understand what listing means.
Yes.
When you say listing, the first thing someone thinks is you've negatively listed me, but
Yes.
they don't understand the value of having a positive credit score. And I do think, number one, the role is not just on, the challenge rather is not on the customer, but it is a role of financial players such as Tala and also CRBs to work together to do that education. So that's the first step. Number two, I do think once you create that inherent value, then for the consumer, then they'll be able to start seeing the benefits. Where, before, if a lender would have not approved you for a loan, let's say you're trying a new digital credit provider, they immediately would not have approved you because they don't have enough data. Now there's increased trust in the data that exists within the credit bureaus and the credit scores that exist there, such that I can get a loan at a higher limit than I would have initially. And I think that's where Kenyans will start to understand the benefit, and we can start to map some of the more developed ecosystems such as the US, where your credit score becomes very important to you. But last thing I'll mention is to your subject that you're bringing up earlier, the value of a credit bureau credit ecosystem is just as important as how many people are included in formal financial ecosystems. And to your point is, we still have a long way to go to pull in everyone to digitize money. I keep saying that our competition and it's still not any of the digital players, it's cash. At the end of the day, how are we incentivizing customers to transact digitally more, which of course means that we are actually able to disburse funds and leverage the same data to underwrite, making it a full cycle.
And Metropol CRB is very serious on financial education. That is why we have episodes like this on our social media platform. If you're not following us yet, you can follow us on Facebook, Metropol CRB, also on X, Metropol CRB. We're also on LinkedIn, Metropol Corporation Kenya. And I know we do this both to the customers and to the businesses, and that's why we have, we organize for breakfasts, like for banks and DCPs, and you can always have these conversations going on. Now, back to you, Mumbi. What initiatives do DCPs put in place to help customers improve or repair their credit scores? Because we were just talking about credit scores earlier. Are there any initiatives in place? We could talk for Tala or generally, just so even as we collaborate with the CRBs.
Good question. I do think there's two things. I can speak on one from an industry level. There's a debt repair framework we have been discussing at large. I do sit on the board of the Digital Financial Services Kenya, which is DFSAC. And we have had of instances where a customer has 10 loans with 10 different players, totaling to $500,000. And I do think that there is a role that players should have thinking through financial health. So that is creating frameworks where the 5 to 10 players who who lend to this individual can actually come together and think about a debt forgiveness program to support and bring people back into financial health. I do think the second bit is there is additional points of collaboration between players within the industry, where you can also share data to really start to look at issues such as over-indebtedness. So, for example, if there's a similar customer is pulling loans from different places, it could be a signal of fraud or a signal of over-indebtedness. And such frameworks have been done very well in other markets such as the US, and I do think there's a big opportunity to have more collaboration, to really push that needle on financial health while also reducing fraud. So I do think that's on the industry side. On the Tala side, for us, we try to maintain a very strong relationship with the customer. What I always say is, and actually our customers know this, you can call Tala anytime if you're having an issue. And number one, we'll actually negotiate a payment plan. So in most instances, for example, last year when we had floods at some point, customers would contact us and we'll actually waive the late fee and think through a payment plan, because it means that your livelihood has been affected. You actually have no way to generate income. So that's one of the ways. And during the COVID period, we also did some large-scale waivers to over 1 billion shillings to just really support Kenyans in a period where we all did not know what was going to happen tomorrow. So I do think that for us is how we think about. The goal is not to have people in debt. And actually that is a big problem that exists that we have to figure out. But if the goal is increasing access and making sure these financial health, then how are we supporting our customers to ensure that they have peace of mind instead of the opposite, which is them being stressed about debt.
And I must commend you on that, because it's one thing to have an appetite for credit where you're borrowing from several credit providers and unable to pay. And it's another to actually be pushed on a corner because of floods, for example, as you're saying, and going into default and being unable to pay your debt, which will in turn, of course, affect the customer's credit score, and they're not able to get credit elsewhere. So we've talked about the credit scores and about CRBs, and maybe you can just highlight for us some key benefits for the DCPs when they're partnering with CRBs.
I would say number one, for me, it's your role actually to consumers, and especially there's a big benefit that is lost to good borrowers when their credit history is actually not visible to other lenders. So I do think there's that big duty to the consumer. I do think number two is these ways we can leverage data via CRBs to underwrite better and actually become, the word I'm looking for is like become more responsible lenders. So when you think about the power of underwriting, you're essentially checking for three things: checking for fraud, ability to repay, and willingness to repay. And I do think that a lot of the data signals that CRBs hold can actually really help to address especially the ability part, because you want to make sure that you're lending to people who actually have the ability to repay you. And this, I think, is a big responsibility for you as a lender. It's not just giving money, but making sure you're doing it in a responsible way. So those are the two things that always come to my mind when I think about CRB. Of course, the more obvious one for people is the incentivized repayment. But I would say the value of incentivizing repayment via, we call it like a stake, like CRB, is also tied in customers seeing the value of CRBs as well, which I think is a big part of the education we need to do.
You earlier talked about a survey you did, and most people are now consuming digital credit because of the regulations. Most of the digital credit providers right now in the market are regulated by the CBK. But are there any regulatory challenges facing the digital credit providers today?
Not necessarily. I would say that it's still in its infancy stages. The regulations are barely, even for us, we've barely been licensed for over 2-3 years thereabout. So I would say it's still early stages. I think the biggest opportunity I see is actually less to do with just digital credit providers, but I think to do with the fintech sector as a whole. There's always a big tension between innovation and regulation and regulatory compliance. And what is always at risk of happening is when there's more stringent compliance, then innovation takes a backseat. Or sometimes innovation is moving a lot faster than regulation. So I do think that being able to work much closer with the central bank to just really figure out how do we have testing frameworks that allow us to put product in front of customers much faster, I think is going to be a big opportunity. And also just moving into the realm of, hey, once you have new products coming in and new technologies, what is the speed within which you can actually get product approvals? I would say those are the biggest opportunities, and that I would say holds true regardless of DCPs or not, but even into companies, all companies that operate within the fintech sector.
Last month was Data Privacy Week. And data privacy is such a big subject. I think we do not talk about it enough. What measures as Tala do you take to ensure data privacy and security for your customers? Because most people ask, even when they call at the CRB and we ask for their ID numbers, the first question would be, what did you need my ID number for? Or my phone number? So what are some of the measures you take to make sure that the data that you keep in your database, there's data privacy for your customers?
Yeah, and number one, the first thing you always have to know is data belongs to the customer. So it's not your data. So when I think about it is, if you need data, one, have you explained it to the customer in the simplest of terms what you need the data for? And I think the challenge that has existed largely is a lot of this information is in large terms and conditions documents that no one essentially reads. But if you're actually able to present this information, which we've done at Tala, in a snapshot during the onboarding process, helps to give customer clarity. Number two, make sure that the consent experience is very clear for the customer. So what am I agreeing to? How do I agree? And if I change my mind, how can I get my data deleted? Because it belongs to me. I think those are the things, processes that have to be very clear. Beyond that, of course, there's a technical side. We're a tech company. So we're ISO certified, of course. Make sure that we have very clear access rules around PII, and especially like very sensitive customer data and information to build that confidence with the customer. But I do think that for me should be the bare minimum we do. I think the big opportunity is in proactive communication to customers.
But I'm even wondering if most people read the T&Cs because
they do not, and that's what I'm saying, right? Because you see what most companies do will be like, click here to accept terms and no one reads it. So I think for me then the bigger opportunity becomes, how do you take the most important parts of that experience and put it in 4 sentences that someone can see, and that's what we've done. It's actually an additional point of friction for the experience, but down the line I do think it builds trust, because to one of the things I were talking about earlier around traditional businesses and fintech, I do think that if you think about fintech, the largest thing is actually trust. There's a lot of trust that needs to be built with customers, which I completely agree with you.
And I hope the other digital credit providers will copy that from you, because then again, most of the time you see the T&Cs are in very fine print. You just click here.
In legalese, no one understands.
And most of the time we just need the money.
Exactly.
We don't have time to read all of that. In finishing, I know we were talking about Hustler Fund earlier, but I also know that there is a rise of alternative lending models, like buy now, pay later. How do you see these, especially alternative lending models, influencing digital credit space?
Yeah, good question. And one thing I always want to clarify is people think of the digital crediting industry as a monolith. What I mean by that is like it's a big blob. If you start to talk to customers, what you'll understand is customers have different needs. Like today, I've just mentioned that our average loan is about 15,000. If someone wants to buy a fridge for their business, we are not giving them enough money to do that. So I think the the way to think about it is different business models in the credit space solve for different challenges. The example you gave with Hustler Fund, it's much smaller loan amounts solving for a very specific need. With Tala, it's solving for a lot of cash flow for businesses and slightly bigger needs. If someone wants to buy something for 200,000, then they're able to actually leverage BNPL players such as Aspira and the rest to actually make those purchases. So I do think that there's still such a massive opportunity and gap to solve for it. But my only opinion with this one is always underlying should be how do we make this easy, transparent, and flexible and accessible for customers? And that's the power of technology. So making sure that I can, if I need something, I can do it very fast on my phone, be able to share the information, be safe in the process, and be able to access the credit I need. And I think that for me is what qualifies digital credit, and it can cover multiple use cases.
I am going to release you, Mumbi, to go continue influencing the nation and building it in your capacity as you do. But I must say thank you very much for sparing the time to come speak with us. When we began, I actually said that this is going to be an in-depth conversation because I know Mumbi has stories, and most of the time they are never empty stories, but very informative ones. We really appreciate for your time coming to the show and speaking to us a lot on the digital space. Thank you very much. If you've not gotten a chance to watch this live right now, you can watch it later. It will be live or it will be on our social media platforms, Facebook, Metropol CRB, on X, Metropol CRB, also on our YouTube channel, Metropol TV Kenya. Thank you very much also to our viewers for keeping it here and just making sure that you give us the company that we really need. We'll see you again next Friday. Mazaliwa. Adios.